Ryder here with another edition of Kathmere's Chart of the Month. We're now less than 6 months away from the 2024 election, which means there are two things I can say with a high degree of confidence we can expect to see in the coming months. One, an increasing barrage of political ads on TV. And two, stock market gurus warning of a market sell-off based on the premise that markets hate uncertainty and that the election is a source of uncertainty that will make for a challenging investment environment in the months ahead. The idea that markets hate uncertainty and thus are poised to underperform in the lead up to election for no other reason than an election is on the calendar is broadly accepted as conventional wisdom by many in the investment community. The reality is that, as with many things that are accepted conventional wisdom in investing, such a view is not grounded in fact in historical data. In this month's slide, I share the results of an analysis from my team, which examined the returns of the S&P 500 index during the 6 months leading up to the last 24 presidential elections, and compared those with the performance of the S&P 500 during the same May through October period in the 74 years since 1926 that did not feature a presidential election. What we see clearly here is that, contrary to popular opinion, the stock market on average has delivered stronger performance in the 6 months leading up to a presidential election than it has during the same 6 months in non-election years. As is always the case with investing, there are sources of risk and uncertainty facing the market that could lead to a near-term market sell-off. Risk and uncertainty are always present in investing. The outcomes of elections are, of course, consequential for us and for our future generations, but their impacts to the economy and markets are not usually direct, immediate, or even clearly apparent. We therefore believe it's nearly impossible to design an effective and repeatable investment strategy around election cycles or anticipated political outcomes. Ultimately, we believe investors are better served when their investment strategy is driven by the unique goals, time horizon, and risk tolerance, and not the political cycle. That's it for this month. We thank you for joining us, and we'll see you next month.